Hey YouTube, this is Mike Campos here with San Diego Funding, and today I'm going to talk to you about a very powerful mortgage program called the Cross-Collateralization Loan Program. Now, if you're a home buyer or a homeowner who's looking at buying real estate, this YouTube video is geared mostly towards real estate professionals that I partner with on a regular basis. You're welcome to watch the video, but just know that there's going to be some language in here that might be a little bit more industry specific. So feel free to message me below if you have any questions or inquiries. The cross-collateralization mortgage program utilizes the equity of a client's existing real estate in lieu of a down payment on the new purchase property. So if a customer is looking at purchasing a property between $1 million and $10 million, and their cash availability, their equity that they would traditionally use to purchase that property with is inside other real estate owned, you're going to have a challenge in getting that money out, whether we have to sit and wait to do a refinance on that existing property to get that money liquid so he can use it on down payment on another property, whether you have to list that piece of real estate, put on the market for sale, go into escrow, get pending, close escrow, get the proceeds, and then you can move forward with a closing on the new property. So a lot of those options, take time away from writing an offer and getting acceptance on a new property. And so that time puts your client at risk of not getting that property because the seller sometimes isn't going to wait. They're not going to wait for the buyer because the market's strong enough to have other offers that possibly might come in from anywhere in the world. So the cross-collateralization loan program is a 30-day escrow. It is where a current client has a 1 to 4 unit property in their real estate portfolio that has significant equity. It could be their primary residence, a second home, or a rental property that could be 1 to 4 units. As long as it's residential, we can use it. From there, they're looking at purchasing a new property between $1 million and $10 million. What we do is we take the value of the subject property and the value of their real estate owned. We can use 1 unit at a time, 1 property at a time. The property could be 1 to 4 units. We take the subject property and the collateral property and calculate a combined value. From there, we can lend between 65% and 75% of that combined value, depending on the loan amount. So if it's on the lower end, like a $1 million rental property and a $2 million purchase property, that's $3 million, we can lend up to 75% on that combined amount. So what this does is that it allows the client to purchase the new property at 100% financing because we are putting a lien, we are collateralizing the equity on the other property owned. So at the end of the day, they'll have 2 properties owned, 1 mortgage, 1 monthly payment. And then, typically what happens is that the customer will purchase the property on a 30-day escrow, close with a loan at 100% financing, and then eventually they sometimes sell that other property after they move into the new home. When they sell the other property, the lien will be paid off, and the excess equity in that home will then be applied towards the principal balance of the new property. So sometimes the person may purchase a property at 100% financing at $2 million sales price. And then when the departure home is paid off, the equity position may pay down that balance to $1 million. And so their hypothetical monthly mortgage payment at $2 million might be $20,000 a month. And then after the departure home is sold, the new balance will become $1 million, thus their monthly payment going down to $10,000 a month. So there is no additional cost for when the customer sells the move-out house and pays down the balance on the new property to the lower loan amount. The bank at no additional cost will re-amortize the monthly payment based off the new principal balance. The loan terms that are available on this cross-collateralization loan is a 5/1 arm and a 7/1 arm. Both of those loans are typically principal and interest, or fully amortized over 30 years, a principal and interest payment amortized over 30 years. the client has the option to entertain an interest-only payment as well. This loan program allows for a credit score as low as 680, so that's actually very generous. And they also allow up to a debt-to-income ratio of 47%, which is pretty aggressive. So it's a very aggressive product to help your clients purchase real estate now without having to wait to sell or refinance another piece of real estate that they already own. This will help increase the odds of your client getting the acceptance from the seller because they're non-contingent, and because we're going to be a 30-day escrow as well. So it's a very aggressive product. We have great terms, and we're here at San Diego Funding. We're very forward-thinking. So if you or your client would like more information about how this program may apply to them and help them succeed in purchasing another property, feel free to message me below, and I look forward to talking to you soon.